So why do we look at calendar events to find high probability, one directional trading opportunities? So for the month of February, we had two events. The first event, which was the best one, was the US CPI, which came in hotter than markets were expecting, beating across the board and coming in above maximum expectations for the month on month reading at 0.5%. So we were trading that live at the time. Clear opportunity. We're looking for downside in the S&P 500, and we were looking for a move down to the third pivot point, and we saw that drop down to the S3 pivot point intraday. Good opportunity, one that was the best of the month. We had a second opportunity as well the day after with the UK GDP print. Look, surprising across the board. Now, really, we're looking for opportunity to short the pound, but with this really surprising markets across the board, above maximum expectations, it did provide a short-term opportunity for pound dollar upside, particularly in line with the particular dollar weakness we had at the time. So that was another opportunity to take a pound dollar long out of the event. Now, I was taking out a break even on this trade because it was sort of medium sort of conviction compared to the CPI print, but still a good opportunity, and you see it did work out nicely. So that sort of hunch that was a significant move to get into was right. But the CPI on the 12th was the best opportunity of last month. So that's why we look at these high probability calendar events. They don't happen all the time. There's one, two, three, four in a month. Sometimes you might get five. Sometimes you only get one a month. So it does vary in terms of how often you get these events, but they are worth looking for because when you do get them, they do provide those unidirectional opportunities. So now let's look forward to the coming week. Okay, as we come to this week, there's three risk events that we want to be looking at. The first one is the Swiss CPI print. Now, the SNB have been reminding markets that they do have open to them the prospect of using negative interest rates. They don't want to use it necessarily, but they will do if they have to. Now, the reason this is important for Switzerland is because they have a 0 to 2% inflation target. And if you just take a look at the current year-on-year inflation data, you can see it's down at 0.4% for January. So clearly towards the bottom end of their range. And if we keep seeing this falling lower, then the prospect of negative interest rates are going to come back, and that should weaken the Swiss franc significantly, especially if we have a data point that suddenly puts negative interest rates right back on the table. So what we're looking for here is a surprise print below market's minimum expectations, and that should allow the Swiss franc to weaken when we look to pair it with a stronger currency, or we'd look at using the Swiss franc futures market. So Swiss inflation data, definitely one to get early on Wednesday. The next data point is the US ISM print. Now, the headline S&P Global US PMI Composite sank to 50.4 on February the 21st, down from 52.7 in January, according to the preliminary flash reading. And that drop took the index to its lowest level for over a year, just showing like a stalling of business activity. And the weakness was centered on the services economy. Remember, the US is a service-driven economy. It was the first contraction in the sector for 25 months. So for the first time in 2 years, we saw a contraction in the services sector. The downturn in activity was down to worsening new orders and growth in political uncertainty. So it could turn around, but this is definitely one to look at, the US ISM. The ISM is more influential in terms of the market reaction compared to the S&P Global print. So this is definitely one to us look at. We want to see how those services are actually doing. Another miss here, then you expect a flush lower in the S&P 500. Definitely one for us to keep an eye on. And of course, the most important data point of the week is going to be the non-farm payrolls on Friday. Powell has been really happy that the labour market has been robust. There isn't like a massive crunch in the labour market, so that's been allowing the Fed to keep that cautious monetary stance. So what we're looking for here is either a confirmation that cautious monetary stance can be maintained, or the first signs of significant cracks in the US labour market. This is definitely one to keep an eye on. There's been a lot of sort of cost cutting going on with US administration as well. So it'll be interesting to see if when we start seeing that turn up in the data. But definitely non-farm payroll print is going to be a good one. If we see a very strong jobs data point again, then we'd look for downside in the US equity market, and we'd expect dollar strength on the back of that. So non-farm payrolls ones not to miss. 3 good events actually this week, all 3 in their own merit are worth turning up for. So a bit busier this week, which is nice, and 3 good events to keep us occupied for this week. I look forward to seeing you in the sessions. Take care. Speak soon.